Hey, Matt Rosenberg here with RoseCap Financial, and it's been a few weeks since my last video, and that's because it's been a busy few weeks here at RoseCap. First, we wrapped up our tax season this July 15th, and I was really excited to get one on the books with Nancy Harward on board. And now we have additional capacity for taxes too, which is nice. So if you filed an extension or you just want to start talking 2020 taxes, please don't hesitate to reach out and let us know. Another reason I've been busy is I was actually asked to present at the National CPA Conference, which is normally held in Las Vegas during the summer. That, as you can imagine, was postponed in person, and then we did a virtual conference this last week. So I got to deliver my presentation to CPAs all over the country, actually from right here in Grand Junction. My talk covered two broad topics. The first was to just give a market outlook on kind of what I see happening with the economy and the markets over the next year. And then second was to discuss some ways that investors can actually play defense with their portfolio, considering that there's a lot of volatility and maybe some uncertainty going forward. So I'd love to share that recording with you, but it's actually something that the AICPA charges people to listen to, so I can't repost that. But I figured I created it, so I'll just share the same information with you and do that in a video. So this video might be a little longer than normal, and if you're not interested, no worries, you can tune out right now. But otherwise, here we go. The presentation I gave for the AICPA was about an hour, so I'm going to skip a lot of the capital market outlook and some of the other topics and just cut to this part where I talked about the different strategies for playing defense during volatile times. So here's a list of the strategies I covered. The first one is just move to cash. So basically sell a portion of your portfolio and go to cash. Investing with annuities, structured products, or defined outcome investments, and then using options or other derivatives to try to create safety in a portfolio. When things were really all over the place back in March and April, it wasn't uncommon for me to get a call from a client and say, hey, Matt, maybe we should sell a portion or all of my portfolio to cash just to get out of the market until things settle down a little bit. And I think this slide here shows does a good job of showing why that would be a mistake. And what we're looking at is basically this bar on the left is showing the return of the S&P 500 if you stayed invested fully over a certain period of time. And then the next bar is showing the return if you had missed just the 10 best days of S&P 500 performance over that same time period. And you can see the return is less than half. If you miss the 20 best days, again, less than half of the previous one, and how bad the returns get if you miss some of these big days in the market. So staying invested is very important. One of the things I don't have a slide to show, though, is how the best days in the market tend to be very close to the worst days in the market. And that's exactly what we saw back in March and April as well. I'm thinking March 12th of this year when the stock market went down 10%. But then the very next day on March 13th, it went back up 9.4%, the fifth highest increase in a single day ever. March 16th, the same exact thing happened. The market went down 12.9, but then March 24th, went back up 11.4. So if you stayed invested through that whole time period, the net loss to the portfolio of the stocks was only 2%. But if you made the mistake of saying, okay, big down day, let's get out, you could have cost yourself 10, 12% in a portfolio. And that's a very hard thing to recover from. The next bullet point on my list was annuities, and I don't have a slide prepared for that. But I'll say that an annuity is an insurance product. So if you're using it for insurance, which would be to insure against outliving your savings, then it could potentially have a fit in a financial plan. For most people, they don't need it because they have Social Security to fill that role. Investing with an annuity to look for safety, I think, is a huge mistake. And that's because it's going to be very expensive. It doesn't really add any value over what we can do with an asset allocation. And then it also really limits your options going forward too. So I don't have a slide, but generally speaking, annuities are not something we want to recommend. So a structured product, or these have kind of been reinvented now, and they're called defined outcome investments, is basically a repackaged investment from a bank or an insurance company that's trying to narrow down the range of returns from investing. And these tend to appeal to people who say, you know what, I don't really need to hit it out of the park with my investments. I just don't want to lose a lot of money either. And so what they do is put a floor on the amount of losses that can be realized in an investment. And then in exchange for that, they put a ceiling on it too, where they say, okay, we'll limit your downside. Usually it's 8 to 10%. And in exchange, we're going to cap the upside that you can make. Usually that's kind of 10 to 12%. To show you how this looks, I've put this chart up here, and the blue lines represent the floor and the ceiling to these investments. The bars, the red and the green, are the historical returns of the S&P 500 over the last 30 years. And you can see how this worked out. There's a lot of green bars that go above that cap, and there really isn't that many below the floor. So if you would have invested in these, then you really cost yourself a lot of money. The other disadvantage of these is they can be very expensive in terms of they have high expense ratios. And now these new defined outcome ETFs that are traded daily offer a whole new level of complexity that has to be looked at before investing. This is because the floor and the cap get set when that investment's offered, and then once it's going, the investment can approach that floor, which results in a very disproportionate risk-return trade-off for the investor. So you really have to know what you're doing if you're going to use these. But in general, I don't recommend these either as a way to limit your risk. Options are another way that you can try to create some safety in a portfolio or reduce risk, or even other derivatives. What I'm going to show here is one of the most common strategies for creating safety in a portfolio with options, and it's called a protective put. And it's very simple. It's basically just buying a put option on a stock or an index that basically allows you to sell that for a known price in the future. The difference here between this and the structured products is now we don't have the downside. We've essentially insured our portfolio from losses, but we still get the upside if the market goes up. So this can also be an attractive strategy, but here's why I don't think this is something that makes sense. What I'm showing on this slide is the option chain for put options for the SPY, which is the S&P 500 index fund. The price of that is $307 when I pulled this on June 24th of 2020. So what I've circled in red here, this 9.74, that's the cost to buy one put option on the SPY. And as you can see, that's 3.17%. So I guess what I'm saying is that is a very expensive form of insurance. To put that into context, that would be like if you had a $500,000 house and you wanted to insure that from a loss for a month, it would cost you $15,000 a month to keep that value from going down. And that's a month. You can do these for longer term. So the lower chart is the option chain on a 1 year SPY put option. And you can see the cost of that is almost 11%. So again, if I wanted to insure my $500,000 home from a loss for 1 year, it would cost me $55,000. That is very expensive insurance, not something we recommend. There's a lot of other option strategies out there where you can combine put options with call options to basically create a parameter around your return outcomes. And I won't get into all those in the interest of time. But I guess you could say one of the reasons we don't like those is same thing, the cost. So what I'm showing in this orange box is basically the spread from trading these options. And so the ask, that's the price I pay if I want to buy an option, and the bid is the price I pay if I want to sell an option. So every time I'm transacting in these, it's essentially a 0.4% cost of trading. If I go longer term, you can see on these leaps, these long-term options, it's 1.88% every time I trade this. So to put that into context, our advisory fees for helping you are typically in the 0.5% to 1% range, and that's for a year. So here, every time you trade these options, you're looking at 0.5% to 2%. That's really expensive. Not doing my job if I'm running these costs up on you. So options are sometimes attractive and appealing. The complicatedness of it also appeals to smart people who think, oh, I want to have these option strategies on my portfolio. But at the end of the day, I just think it hurts your long-term probabilities of accumulating wealth. So I just covered 5 popular ways to control risk in a portfolio, and I pretty much said that none of them are things that we'd recommend. So just so you know, Rosecap Financial is an independent firm. So if any of these strategies were beneficial for you, we could certainly use them in your accounts. And we also have a fiduciary responsibility to you. So not only would we be able to use them, but we'd be obligated to. Unfortunately, investments are like a lot of things in life, in that the more complicated and fancy something seems, the less value you're actually going to get for it. So, what's the best way to actually control risk in a portfolio? Asset allocation. Asset allocation means having the appropriate mix of stock, bond, and other securities for your financial goal. In some ways, it can be very easy, like we want a 60% stock. And in other ways, it can be pretty hard, like how much of our bond allocation needs to be in mortgage backs or agencies versus tips, and then what is the appropriate duration we want on that bond allocation. So, having the correct allocation, staying diversified, rebalancing, minimizing fees, minimizing taxes will not only do the best job of controlling risk for you, but it also doesn't charge any additional fees like these other gimmicky strategies can. And guess what? This is what you're already paying Rosecap to do for you. I hope you found this information helpful, but as always, if you have questions or want to discuss more, please don't hesitate to reach out to me. It's always great to hear from you.